Hi guys, welcome back. In this video, we're going to be discussing about gross national income. So let's get started. So guys, in order to understand gross national income, we have to understand the fact that, the income that is generated because of the output that is produced in a country is different from the income that is received, right? So there are two things that we're talking about: the income produced or income generated because of the output that is produced, so the output produced is different from the income that would be received in, let's say, 2024. And there are multiple reasons. And because there's a difference between the income produced versus the income received, that is why the value of GNI, gross national income, differs from the value of the GDP. So when you're talking about GDP versus GNI, there's a difference because GNI takes into account the income received, right? And GDP takes into account the income produced because of the output produced in the country. So when we arrive at GDP at market prices, that is when we add up taxes and deduct subsidies from GDP at basic prices, that is GDP at factor cost. When we arrive at GDP at market prices, so that is providing us, it's measuring basically the total output that is produced in Pakistan, let's say, and obviously of the total income that is generated in Pakistan as well as a result of that production. But the total income that is received in Pakistan would be different from the Pakistani residents, and by residents we mean the individuals, the households, the firms, and the government, the state. That is all the key players in the economy. So the income received by the Pakistani residents would be different from the GDP, and there are two reasons that I have outlined here. That because that's the reason why the difference arises, and that is because you see when you are some of the domestic production basically or the output produced in Pakistan, that output would create factor earnings for non-residents who are maybe doing some sort of work for Pakistani residents. So let's say some people who are living in USA are working for are doing some sort of a consultancy for any Pakistani firm, right? So they're doing some paid work for Pakistani residents, or maybe have some sort of investments in Pakistan. They own some let's say property in Pakistan against which they are receiving factor incomes, but they're not residents of Pakistan. Although that income is generated in Pakistan, but you see that income belongs to the USA resident, right? So in this case, I mean, that income would be repatriated back to USA. And so the income that would be received in Pakistan would be less and would be deducted by that amount of the income that is repatriated back outside of the country. In this case, the income received by the Pakistan's residents will be less than the Pakistan's GDP because Pakistan's GDP would factor in all the incomes or include all the incomes that are generated or output that is produced in Pakistan or the income generated in Pakistan, irrespective of whether that income accrues to or belongs to Pakistani residents or not. Again, I'm going to repeat that when you talk about Pakistani residents, you're including the individuals, the firms, and the government, right? All the key players in the economy. And the second reason is, which is also more or less linked with the first reason, but it is just over there we were measuring income flowing out, but now we'll measure income flowing in Pakistan. So the second reason is that many Pakistani residents are also earning income from working overseas, right? Such as we call them overseas Pakistanis. Um, or maybe Pakistani people also make overseas investments, right? So, I mean, all the money that they're earning there, some of them, either all that money or some of the money, they're repatriating back to Pakistan. So the income that is received by Pakistani residents in this case is much greater than the GDP that would be generated or the out in Pakistan, because all that income is not really generated or produced in Pakistan, but then it's actually received in Pakistan. So since it is received in Pakistan, it will be included in the GNI, but not in the GDP. So we need to, if we have the GDP right now in front of us, then we need to add that income, right? Because GDP is measuring the output and the income because of that income that is earned because of that output produced in the country, while the GNI, gross national income, is measuring income that is received by this country. So the GDP is measuring the output produced or the income generated by this country, irrespective of whether that income belongs here or not. And the GNI measures the income that is received by this country. So if you send back the income, which doesn't belong here, let's say, but earned here. So if it's earned here, it's part of Pakistan's GDP. But if it's sent back to wherever it belongs to, then that income is not received in Pakistan. It will be deducted, right? And then the income that is not earned in Pakistan but belongs to Pakistan would be added back, so it would be received in Pakistan and hence be part of GNI, but not be part of GDP. In fact, it would be part of that country's GDP to where it was earned or generated. Like I said previously in my previous videos as well, that GNI is also called GNP, right? They both are the same, by the way. So, and initially it was called GNP, later it was turned to GNI. So, total output that is produced in an economy and the resulting income that is generated because of that production, which is obviously measured by GDP. The GDP measures that output and it also measures the income as well by adding up all the factor incomes against the output that is produced. Because I've told you previously, I've told you guys as well that domestic production creates factor. Domestic production creates factor incomes because it creates an income claim against that production. So it's going to differ from the total income that is received measured by the GNI because of the net factor income from abroad. And the reason why we're using the word net here is because we're going to be, so the income that is received minus the income that is paid would be deducted. So it would be netted off, right? The income paid would be offset against the income received. So the final figure would be added to the GDP. If it's a positive figure, it would be added. If it's a negative figure, it would be deducted. So that is why the word net is used. Otherwise, net, common, and by the way, so net is, over here is used in the context that the income received will be deducted from income paid. Sorry, the income paid will be deducted from income received. But you see, when you in national income accounting, especially when you're talking about in the context of national income accounting, so the word net, when you talk about the word net, it is used in the context when you deduct capital consumption, that is depreciation. And the word gross is used to indicate that you haven't deducted capital consumption yet. That is why you see when you use the word gross national income, you haven't deducted capital consumption from it, right? GDP, it's not deducting capital consumption. So the word gross means capital consumption or depreciation is not deducted yet. Okay, so GNI is basically GDP plus the net factor income from abroad, right? So the net factor income, I have actually given a few examples, not a lot, but a few examples so that it could just give you more context. So, for example, let's say employees' compensation. Employees' compensation is another word for wages and salaries. Wages and salaries is also an accounting term. So economists prefer. When you're measuring national income accounting, if you actually look at how the national income accounts are measured, the especially employees' compensation is used, especially if you're going through the UK formats. Anyway, so the employees' compensation receipts from the rest of the world minus the payments to the rest of the world, right? For example, let's say that if I'm a Pakistani-based consultant and I sell my services to a UK firm, and that work is done in the UK, then the income will contribute to Pakistan's GNI. Why? Because I will bring that income back to Pakistan, but it will be part of the UK's GDP because it was earned or generated in UK, right? So it will be deducted from UK's GDP to arrive at the UK's GNP, while it would be added to Pakistan's GDP to arrive at Pakistan's GNI or GNP, right? Also, there are other sorts of incomes as well because factor incomes are of multiple types, such as property or entrepreneurial receipts from the rest of the world. Again, minus because we are calculating net, minus the payments to the rest of the world. So, for example, if I live in Pakistan and we're talking about property here, so if I own a holiday home in Spain, let's say, and I rent that holiday home for the part of the year, so rental income, which is the revenue that I will receive, will be counted as part of Spain's GDP because it was earned in Spain. So I need to add it to Pakistan's add it to Pakistan's GDP to arrive at Pakistan's GNI, right? So it's part of GDP in Spain, and but since it accrues to a Pakistani resident in Pakistan, so it will be added to Pakistan's GNI. I mean, it will be part of Pakistan's GNI. When I've written here, it adds to. Oh yeah, I've written it adds to Pakistan's GNI, So it will be added to Pakistan's GDP to arrive at Pakistan's GNI. Okay. Anyways, so a lot of Pakistani firms as well, they own subsidiaries, that is branches located in other countries, and the value added of those subsidiaries counts as part of GDP in the host country, meaning in the country in where that is hosting those Pakistani branches. Let's talk about USA. So if I own a business and I have a branch or subsidiary in the USA, so the value added by that subsidiary and all those multiple subsidiaries that are not only owned by me but by many other people would be counted as a GDP of USA, right? But value added simply is GDP based on output. I mean, if you add that value up that is produced by each firm, it would each firm in different industries, you arrive at GDP at basic prices, or GDP or value added at basic prices, or value added gross value added at factor cost. And it is also equal, by the way, the total value that is added by all the firms in under different sectors in the economy, such as agriculture, banking, finance, insurance, health. So if you add that all that value added, you arrive, like I said, you arrive at GDP at factor cost, or GDP at basic prices, or gross value added at basic prices, all mean the same thing. And that is actually equal to all the factor incomes that are earned in the economy, because like I said, that production output creates an income claim, right? So the value added is actually equal to the factor incomes. So what I was saying was that if I own that subsidiary there in USA, so that's part of USA's GDP. The I mean, whatever output produced by that subsidiary is part of USA's GDP. The value added by this subsidy, I meant, is part of USA's GDP. But if that revenue, since I said that the value added is equal to the factor incomes, but if those incomes are remitted back to the country, let's say, um, if I copy this example and I paste it over all the firms under different industries in USA that are actually operating in USA but belong to Pakistan, and if they remit back their incomes, so obviously that's part of Pakistan's GNI, so it will be added to the GDP of Pakistan to arrive at GNI, right? And another example could be a Japanese firm, let's say, located in Pakistan, contributing all its value added to Pakistan's GDP. So whatever value added this year, whatever value the Japanese firm adds this year in 2024, let's say, to Pakistan's GDP will be part of Pakistan's GDP. But obviously, since the value added equals the factor incomes as well, so the profits that would be remitted back to Japan by this Japanese firm, assuming all are remitted back, are deducted from the GDP of Pakistan in order to arrive at the GNI of Pakistan, as they're not part of Pakistan's GDP. Because I said, right, at the start of the video, I said that the GNI is basically measuring income received. So since that income is remitted back to Japan, it's not there in Pakistan's pocket, so it's not part of income received. So that's it for this video, guys. I'll see you all around in the next video. Until then, take care.